You sit down, you open the charts, you see movement, your hand moves to the mouse, you click, you enter, and then you wait. But not really. You refresh, you check, you move your stop loss, you watch the candles like they owe you something, and by the end of the session, you're tired, not from the work, from the wanting. Most people think trading is about reading the market, about finding setups, about being right, but that's not why they lose. They lose because they're hunting, and hunting in trading doesn't work because the market doesn't care how badly you need it to move. There's a reason professionals talk about trading the way fishermen talk about the water. It's not a metaphor, it's a warning. The mistake starts before you even place a trade. It starts with the belief that effort equals results, that the more you watch, the more you act, the more you engage, the better you'll do. This works in most of life. In school, more hours studying usually means better grades. At the gym, more consistency means more strength. But in trading, more effort often means more loss, because trading rewards patience, not participation, and most people can't tell the difference. When you chase profits, you're not trading, you're reacting. You're scanning for setups that fit your need, not setups that fit the market. You enter because you've been watching for 2 hours and feel like you should do something. You exit early because you're afraid the profit will disappear. You re-enter because you don't want to miss the move you just left. Every decision is colored by urgency, and urgency is expensive. This isn't a discipline problem. It's not even a strategy problem. It's a nervous system problem. Your brain is wired to seek resolution. When you sit in front of charts, your mind interprets the waiting as tension, and tension asks to be released. So you click, you act, you trade, not because the opportunity is there, but because the discomfort is. Think about what happens in your body when you're waiting for a trade. Your shoulders tense, your breathing gets shallow, you lean forward slightly, closer to the screen, your eyes scan faster. You're not relaxed, you're coiled, and your brain reads this physical state as danger, as something that needs to be resolved. The easiest resolution is action. Any action. So you take a trade that's almost right, or you enter too early, or you convince yourself that this time it's different, that this marginal setup will work out because you feel strongly about it. But feelings in trading are expensive. They cost you entries you shouldn't take, exits you make too soon, stops you move because hope feels better than loss. Every emotional decision is a leak in your edge, and most traders spend years trying to fix their strategy when the real problem is they're trading from a state of tension instead of a state of readiness. Now, imagine two traders. Both have the same capital. Both learned from the same course. Both trade the same market. One of them, let's call him Daniel, believes that trading is about finding opportunity. He watches the charts for hours. He marks levels. He waits for confirmation. And when he sees something that looks good, he enters. He takes 5, maybe 7 trades a day. Some win, some lose, but he feels productive. He feels like a trader. Daniel wakes up and the first thing he does is check the charts. Before coffee, before anything. He needs to see what happened overnight. Did he miss something? Is there a gap, a move? He scrolls through his watch list. He checks 6 different pairs. He opens his Discord. Someone posted a setup on gold. He looks at it. It's not his strategy, but it looks interesting. He marks the level. Maybe he'll watch it. By the time the London session opens, Daniel has been looking at charts for 90 minutes. He hasn't placed a trade yet, but he's already tired. His eyes hurt. He's consumed 12 different opinions. He's second-guessing the levels he marked yesterday because someone else is trading the opposite side. But he stays. He watches, because this is what traders do. When he finally takes a trade, it's not because his setup appeared, it's because he's been watching for so long that anything remotely close to his criteria feels valid. He enters, the trade moves against him slightly. He doesn't like how it feels. He closes it for a small loss. 5 minutes later, the trade would have worked. He's frustrated. He feels like the market is playing with him, so he looks for another trade to make up for it. By the end of the day, Daniel has taken 8 trades, 3 small wins, 4 small losses, 1 break-even. After commissions, he's down slightly. He tells himself tomorrow will be better. He just needs to be more disciplined, more focused. He needs to refine his entry criteria. He watches a YouTube video about price action. He takes notes. He goes to bed thinking about the trades he took and the ones he missed. The other trader, Maya, believes that trading is about positioning. She opens her platform once in the morning. She checks her setups. She places 1 or 2 limit orders at levels she's already identified. Then she closes the screen. She goes about her day. She doesn't watch the market move. She doesn't care if her orders get filled. If they do, her stop and target are already set. If they don't, she checks again tomorrow. She takes 3 trades a week, sometimes 2. Maya's morning is different. She wakes up, makes coffee, sits down for 20 minutes. She opens her journal first, not her charts. She writes down what she's looking for today, not what she hopes will happen, what the market needs to show her before she's willing to risk capital. She's specific. She writes down the exact price level, the context she needs, the time window when it matters. Then she opens the charts. She checks her 3 pairs. She looks at her levels. Are they still valid? Has the structure changed? If yes, she adjusts. If no, she sets her alerts. She places her limit orders at the prices she already decided on. She sets her stop loss and take profit before the order is even filled. Then she closes the platform. She doesn't keep it open in the background. She doesn't check it on her phone. She walks away. She works on other things. She reads. She exercises. She has a life that doesn't revolve around the next candle. Around lunch, she checks if her order's filled. If they did, she glances at the trade. Is it still running according to plan? If yes, she leaves it. If it hits stop or target, she makes a note in her journal. 1 sentence. Then she closes the platform again. After 6 months, Daniel is break-even, maybe slightly down after commissions. He's tired. He tells people trading is hard, that the market is unpredictable, that you need to stay sharp, stay engaged. He's not wrong exactly, but he's also not making money. He's thinking about taking another course, about switching strategies, about finding a mentor. He believes the problem is his method, so he keeps searching for a better one. Maya is up, not by a lot, but consistent, enough that she's increased her position size. She doesn't feel tired. She feels calm. When people ask her about trading, she doesn't talk about setups or indicators. She talks about waiting. She says trading is boring, and she means it as a compliment. She's not looking for a new strategy. She's deepening her understanding of the one she has. She's learning to recognize her setup faster, to trust it more, to let it breathe. The difference isn't in what they know, it's in what they're trying to do. Daniel is trying to catch movement. Maya is trying to be there when it happens. One is chasing, the other is positioning. And in markets, positioning always wins. Here's what's happening under the surface. Every time you take a trade out of impatience, out of boredom, out of the need to feel involved, your brain registers it as valid activity. It doesn't distinguish between a good trade and a busy trade. It just knows you acted. And because acting feels like progress, your brain rewards it with a small hit of dopamine. Not because you made money, just because you did something. Over time, this builds a feedback loop. You start associating the act of trading with the feeling of being a trader, so you trade more. Not because the setups are better, because the feeling is familiar. You become addicted to the motion, not the outcome. And motion without a strategy is just noise. This is the same neural pathway that makes slot machines so effective. It's not the winning that keeps people playing. It's the act of pulling the lever, the lights, the sound, the motion. The brain learns that this motion equals engagement, and engagement feels like meaning, so you keep pulling. In trading, every time you click to enter a position, your brain gets that same small reward. You're in the game, you're active, you matter. But here's the problem. The market doesn't care about your dopamine cycle. It moves according to supply, demand, liquidity, and structure. Your need to feel involved doesn't change any of that. So you end up taking trades that fit your emotional need, but not the market's reality. And those trades cost you, not just in money, in clarity. Because every bad trade you take teaches your brain that this is what trading looks like: busy, reactive, exhausting. The fisherman doesn't cast every 5 minutes. He doesn't change spots because he's bored. He finds the right water, he sets up, he casts, and then he waits. If the fish aren't biting, he doesn't panic. He doesn't assume he's in the wrong spot just because nothing happened in the first 20 minutes. He knows the fish move in rhythms, feeding windows, current shifts, temperature changes. His job isn't to make the fish bite. His job is to be ready when they do. Think about what a fisherman actually does. He studies the water before he even arrives. He knows the species he's targeting. He knows what time of day they feed. He knows what depth they swim at. He knows what the weather does to their behavior. He doesn't show up and randomly cast into any water that looks nice. He shows up with a plan, and then he executes that plan. If the conditions aren't right, he doesn't force it. He either waits for them to change or he leaves. When he casts, he's not hoping, he's positioning. He's putting his line exactly where he believes the fish will be, and then he waits. He doesn't reel in after 30 seconds because nothing happened. He doesn't switch to a different lure every 2 minutes. He trusts his read of the water. He trusts his positioning, and he gives it time. If he gets a bite, he doesn't panic. He doesn't jerk the rod. He waits for the right moment to set the hook. Then he reels with patience. Not too fast, not too slow. He works with the fish, not against it. And when he lands it, he doesn't immediately cast again. He takes a moment, he resets, he considers whether the conditions are still right for another attempt. Trading works the same way. Markets move in cycles. Volatility comes and goes. There are hours when the market is active and meaningful, and there are hours when it's just drifting. If you're sitting there the whole time trying to extract profit from every minor fluctuation, you're not trading, you're gambling on noise, and noise doesn't have an edge. The New York morning session has character. There's volume, there's direction, things happen. The Asian session often drifts, low volume, ranges, chop. If you're trying to trade the Asian session the same way you trade New York, you're fishing in the wrong water. The fish simply aren't there. But most traders don't adjust. They apply the same energy, the same intensity, the same expectation to every hour of the day, and then they wonder why their results are inconsistent. The hidden principle here is what some call selective aggression. It's not about being passive, it's about being patient until the moment asks for action. Then you act fully. You don't hesitate, you don't second guess, but you also don't act until that moment arrives. Most traders reverse this. They act constantly and hesitate when it matters. They take mediocre setups quickly and perfect setups slowly, because by the time the perfect setup arrives, they're already exhausted from all the trades that didn't matter. Selective aggression means you're calm in the waiting and decisive in the execution. You don't confuse the two, and you definitely don't try to stay engaged during the in-between. The in-between is where losses hide. There's a reason why the best traders often talk about being lazy. They're not actually lazy, they're selective. They've learned that most market movement is irrelevant to their edge, so they ignore it. They don't watch it, they don't have an opinion on it. They save their energy and their focus for the small percentage of time when their edge is actually present. This is hard for most people because it requires you to be okay with missing things. You'll miss moves. You'll watch trades work that you didn't take. You'll see setups that almost matched your criteria but not quite, and you'll watch them run without you. And your brain will scream that you're leaving money on the table. But you're not. You're protecting your capital from all the trades that look like opportunities but aren't. So, what does this look like in practice? It starts the night before. You review the charts. Not for 5 minutes, for 20, maybe 30. You mark your levels. You write down the conditions that would make you interested. Not hopeful, interested. You define what the market needs to show you before you're willing to risk anything. Then you close the platform. You don't look at it again until the session starts. This pre-session routine is everything. Most traders skip it. They think they can just show up and figure it out in real time. But real-time decision-making is where emotions live. When you're in the moment, watching the market move, you lose objectivity. Everything looks like it might work. Everything feels urgent. So you need to make your decisions before that urgency arrives. When you mark your levels the night before, you're thinking clearly. You're not reacting to movement. You're analyzing structure. You're identifying where the market might show you something meaningful. You're not predicting. You're preparing. There's a difference. Predicting is saying the market will go up. Preparing is saying if the market reaches this level and shows me this behavior, I'll be interested in going long. When the session opens, you check once. Did price reach your level? Did the condition appear? If yes, you have a trade. If no, you wait. You don't scan for alternatives. You don't try to find something else. You've already decided what you're hunting. If it's not there, you walk away. You do something else. You read, you work, you go outside. It doesn't matter. What matters is that you're not watching the market pretend to give you opportunities. This is where most traders break. They check their levels. Nothing is there. But instead of walking away, they stay. They scroll. They look at other pairs. They wonder if maybe there's something they missed. They check the lower time frame. They look for patterns. And eventually, they find something. Not their setup, but something. And because they've been looking for 20 minutes and feel like they should do something, they take it. And that's where the bleeding starts. If your trade triggers, you manage it according to plan. You don't move your stop because you're scared. You don't close early because you saw profit. You let the trade finish. Then you're done. One trade, maybe two if a second setup appeared at your level, but that's it. You don't go looking for a third just because you have time left in the day. Managing the trade according to plan is harder than it sounds, because once you're in a position, your brain shifts into protection mode. Every tick against you feels like a threat. Every tick in your favor feels like something you might lose, so you start negotiating with yourself. Maybe I should move my stop to break even. Maybe I should take half off here. Maybe I should give it more room. But all of this is just noise. You already made the decision when you placed the trade. You decided where your stop goes. You decided where your target is. You decided what you're risking and what you're trying to make. In the moment, inside the trade, you don't have better information. You just have more emotion. So stick to the plan. Let the trade resolve. Win or lose, it doesn't matter. What matters is that you followed your process. This rhythm sounds simple, and it is, but most people can't follow it because it requires them to do nothing most of the time. And doing nothing feels like losing. It feels like missed opportunity. It feels like you're not really trading. But that's the point. Real trading is mostly waiting. The actual trade is just the confirmation that you waited for the right moment. There's a strange paradox here. The less you trade, the more you feel like you're not doing enough. But the less you trade, the better your results become, because you're only taking the trades that matter. You're only risking capital when your edge is present. Everything else is just market movement, and market movement without your edge is just randomness with a price tag. When you ignore this rhythm, the consequences aren't dramatic. You don't blow up your account in a day. You just bleed slowly. A few trades here that didn't need to happen, a couple of emotional exits there, a handful of setups you took because you were bored, not because they were valid. None of it feels like a mistake in the moment, but over weeks it adds up, and what you're left with isn't just a smaller account, it's confusion. Because you're doing everything you think you're supposed to be doing. You're studying, you're watching, you're executing, and yet the results don't match the effort. That's because the effort is the problem. Let's talk about what this bleeding actually looks like in numbers. Say you're trading with a $5,000 account. Your risk per trade is 1%. That's $50. You take 8 trades a day. Let's be generous and say you have a 55% win rate and your average win is slightly bigger than your average loss. On paper, you should be profitable. But here's what actually happens. Of those 8 trades, maybe 3 are actually your setup. The other 5 are variations. Close enough. Almost right. Good enough because you're already watching. Those 5 trades don't have the same edge as your core 3. So your win rate on those 5 is closer to 45%. And because you're taking them out of impatience, your execution is worse. You exit early, you enter late, you move your stop. So now your overall win rate isn't 55%. It's closer to 48%. And your risk to reward isn't consistent because you're managing half your trades emotionally. Over a month, you take about 160 trades. You win 77. You lose 83. Even with slightly bigger wins, you're break even at best. And that's if you're lucky. Most traders in this pattern are down 10 to 15% over a month. Not enough to quit, just enough to stay confused. The shift happens when you stop measuring your day by how many trades you took and start measuring it by whether you followed your process. If the process says wait and you waited, that's a perfect day, even if you didn't trade, especially if you didn't trade. Because that means you had the discipline to let bad setups pass, and letting bad setups pass is more profitable than taking good ones poorly. Think about what a perfect trading day actually looks like. You wake up, you review your plan, you check your levels, nothing is there. You close the platform, you go about your day. You check once more in the afternoon, still nothing. You close the platform again. End of day. Zero trades, zero profit, zero loss. But also zero mistakes, zero emotional decisions, zero damage to your capital or your psychology. That day is perfect because you followed your process completely. You didn't deviate, you didn't compromise, you didn't let boredom or FOMO pull you into a trade that wasn't yours. Most traders would call that day a waste, but it's not. It's compound discipline. Every day you don't take a bad trade is a day your equity is protected, and protected equity is what allows you to take full advantage of the good days when they come. Over time, this changes how you see the market. You stop feeling like you're in a battle. You stop checking your phone every 20 minutes. You stop caring whether today was volatile or flat, because your job isn't to match the market's energy. Your job is to be present when your setup appears and absent when it doesn't. That's it. That's the whole job. This shift in perspective is subtle but profound. When you first start trading, the market feels personal. It feels like it's challenging you, testing you. When you lose, it feels like the market beat you. When you win, it feels like you outsmarted it. But the market isn't aware of you. It's not trying to do anything to you. It's just moving according to forces far bigger than your position. Once you accept this, the emotional charge disappears. You stop taking losses personally. You stop celebrating wins like you conquered something. You just execute your process and let the results accumulate. Some days you trade, some days you don't. Some weeks are profitable, some aren't. But over months, if your process is sound, the edge reveals itself. The identity shift is subtle. You don't wake up one day and suddenly feel like a different person, but you do notice that trading stops feeling hard. It stops feeling like something you have to force. You open the charts and you know immediately whether today is your day or not. And if it's not, you're okay with that. You're not disappointed, you're not restless, you're just patient. Patience in trading doesn't mean sitting around hoping for something to happen. It means having a clear definition of what you're waiting for and being completely unmoved by anything that doesn't match that definition. It means you can watch the market run 100 points without you and feel nothing, because those 100 points weren't in your setup. They weren't your fish to catch. This is what people mean when they say trading is boring. They don't mean it's uninteresting. They mean it's undramatic. There's no adrenaline, no constant decision-making, no thrill of the chase. Just a simple question: is my setup here? If yes, trade. If no, wait. And that simplicity is what makes it sustainable, because you can do simple every day. You can't do chaos every day. Most people are attracted to trading because it looks exciting. Fast-moving charts, big wins, the idea of reading the market and making quick decisions. But that version of trading doesn't work for most people. It's too stimulating, too demanding. It requires you to be on all the time. And being on all the time leads to burnout, overtrading, and eventually quitting. The traders who last aren't the ones with the most passion. They're the ones with the most patience. They're the ones who figured out how to be okay with nothing happening, who learned to find satisfaction in the waiting, not just the winning. People who chase profits treat trading like a video game. They think the goal is to be active, to stay in the action, to always have a position. But the market doesn't reward activity, it rewards accuracy. And accuracy requires space, space to think, space to wait, space to let the wrong moments pass so the right ones can arrive. There's another layer to this. When you're constantly active in the market, you lose perspective. You start to see every move through the lens of what you could have done. You're always second-guessing, always wondering if you should have entered there, exited here, held longer, cut faster. This constant self-interrogation is exhausting, and it prevents you from actually learning. When you step back, when you trade less, you gain clarity. You can see the market's actual structure instead of just the noise. You can identify the moments that mattered versus the moments that just felt like they mattered. You can review your trades objectively because you're not drowning in dozens of them every week. You took 3 trades. You can remember exactly why you took them. You can learn from each one. If you've been trading for months and you're still tired at the end of every session, that's the signal. You're working too hard. Not because you're studying too much or risking too much, because you're present too much. You're there for the whole movie when you only needed to show up for one scene. This exhaustion isn't just mental, it's physical. Staring at screens for hours tenses your shoulders, strains your eyes, disrupts your sleep. It's emotional. Every trade carries a small weight: hope, fear, regret, relief. When you take 8 trades a day, you're carrying that weight 8 times. When you take 2 trades a week, the load is lighter, and that lightness allows you to show up fresh when it actually matters. Let's talk about preparation in a different way. Most traders prepare by learning more strategies, more indicators, more patterns. They think preparation is knowledge accumulation, but that's not what separates consistent traders from struggling ones. The separation is an environmental preparation. What does your trading space look like? Is it the same desk where you work, watch videos, scroll social media? If yes, your brain doesn't know when you're trading versus when you're just on the computer. There's no context switch. So the discipline you need for trading gets mixed with the relaxation you associate with your desk. This makes focus harder. Some traders create a separate space, even if it's just a different chair, a different monitor setup, something that signals to their brain that this is trading time, not leisure time, not work time, trading time. And in trading time, the rules are different. No distractions, no multitasking, just charts and execution. The same goes for time. If you trade whenever you feel like it, your brain never builds a routine. But if you trade at the same time every day, your focus sharpens at that hour. Your brain knows what's expected. It's ready. This is how professional athletes train. They practice at the same time their games will be, so when game time arrives, their body is already in rhythm. Another thing fishermen understand is seasons. They don't fish the same way in spring as they do in fall. The water temperature changes, the fish behavior changes, they adapt. In trading, the seasons are volatility cycles. There are weeks when the market is trending, offering clear directional moves. There are weeks when it's ranging, chopping between levels. There are weeks when major news is pending and everything is uncertain. If you trade the same way through all these seasons, you're going to struggle. Your trend-following strategy doesn't work in a range. Your breakout strategy doesn't work in a tight consolidation. You need to recognize what season you're in and adjust your expectations. Sometimes that means trading less. Sometimes it means not trading at all. Most traders resist this idea. They feel like they should be able to make money in any condition, but that's not realistic. Even the best traders have conditions they avoid, markets they don't touch, times they step away. This isn't weakness, it's wisdom. There's a concept in trading psychology called permission. Most traders don't give themselves permission to do nothing. They feel guilty. They feel like they're wasting time or missing out. But nothing is an action. Choosing not to trade is a decision, and often it's the best decision you can make. When you give yourself permission to sit out, to wait, to let entire days pass without a trade, something shifts. The pressure releases. You stop forcing, you stop reaching. You become selective, not because you're trying to be disciplined, but because you genuinely don't see anything worth taking. And that genuine discernment is what builds a real edge. Let's go back to Daniel and Maya one more time. A year has passed. Daniel is still trading. He's switched strategies twice. He's taken 3 different courses. He's in 2 Discord groups and follows 5 traders on Twitter. He's learned about order blocks, supply and demand zones, ICT concepts, smart money tactics. He can talk about trading for hours. He sounds knowledgeable. But his account is smaller than when he started. He's added money twice to keep going. He tells himself he's investing in his education, that it takes time, that he's getting better. And in some ways he is. He can read a chart faster. He knows more patterns. But he still can't sit still. He still takes trades he knows he shouldn't. He still watches the charts for hours. He's more knowledgeable, but not more profitable. Maya is still trading the same strategy she started with. She hasn't taken a course in 10 months. She doesn't follow other traders. She doesn't check Discord. Her routine hasn't changed. She marks her levels, she sets her orders, she walks away. 3 trades a week, sometimes 4. Her account has doubled, not from one big win, from consistent execution over time. She started teaching a friend how to trade, not because she thinks she's figured everything out, but because her friend asked. And when she explains her process, she's surprised by how simple it sounds. Find your setup, wait for it, take it, manage it, repeat. That's all she does, and it works because she actually does it. She doesn't deviate, she doesn't experiment, she doesn't get bored and try something new. She just executes the same simple process over and over. The difference between them isn't talent or intelligence or even strategy, it's relationship with waiting. Daniel sees waiting as lost time. Maya sees it as part of the process. Daniel measures success by activity. Maya measures it by adherence to her rules. Daniel is always looking for the next edge. Maya is deepening her current one.
Here's something most traders don't realize until it's too late. The strategy doesn't matter as much as you think. There are thousands of profitable strategies. Trend following works, mean reversion works, breakouts work, support and resistance works. You could probably pick a strategy at random, and if you executed it with discipline, you'd be profitable. The problem is never the strategy. It's the execution. And execution is about psychology, not technique. It's about whether you can follow your rules when you're bored, when you're frustrated, when you're on a losing streak, when you just had 3 wins and feel invincible. The strategy is just a framework. Your psychology determines whether you can actually use it. This is why traders can watch the same course, learn the same setups, and get completely different results. One trader takes the setup only when all conditions align. Another takes it when most conditions align. Another takes it when they think it might work even if the conditions aren't quite there. Same strategy, different psychology, different results. So if you've been jumping from strategy to strategy looking for the one that finally works, stop. Pick one. Doesn't matter which, just pick one and commit to it for 6 months. Don't change it, don't add to it, don't look for a better one. Just execute it exactly as designed. If after 6 months you're not profitable, it's probably not the strategy. It's probably that you're not actually following it. You're taking trades that sort of look like your setup. You're exiting early. You're moving stops. You're trading when you're emotional. The market will teach you everything you need to know if you let it. But you have to give it time. You have to give yourself time. Most traders quit before the lesson lands. They learn a strategy, try it for a few weeks, don't see immediate results, and move on. They never give themselves the chance to actually understand what they're doing. There's a learning curve in trading that most people underestimate. You learn the strategy in a few days, you understand the rules, the entries, the exits, but understanding and executing are different. Executing under pressure with real money, with your emotions involved, takes time. It takes repetition. It takes failing and adjusting and failing again. Most traders expect to be profitable within 3 months. But most profitable traders will tell you it took them 1 to 3 years. Not because the strategy is that complicated, because it takes that long to train your brain out of all the habits that work in regular life but destroy you in trading. Try this. Tomorrow, define one setup. Just one. Write down exactly what it looks like, what the chart needs to show, what the context needs to be. Then check the market twice, once in the morning, once in the afternoon. If your setup is there, trade it. If it's not, close the platform. Don't look for something else. Don't try to stay involved. Just walk away. Do that for a week, not as a challenge, just as an experiment. See what happens when you stop chasing and start positioning. See what it feels like to trade less and wait more. At the end of the week, review your trades. How many did you take? How many were actually your setup? How many were close but not quite? Be honest. Write it down. Then do another week and another. After a month, you'll have data. Real data about your execution, not just your strategy. You might notice something interesting. The trades you took when your full setup was present probably did better than the ones where you compromised. Even if some of the compromised trades worked, the ones where everything aligned likely felt different, calmer, more certain, less stressful. That feeling is what you're chasing, not the feeling of being busy, the feeling of being right. And being right comes from being selective, from waiting for your moment instead of forcing moments that aren't yours.
You might be surprised, not by how much you make, by how much lighter it feels, by how much more space you have in your day, by how trading stops taking over your life and becomes just one thing you do, not the thing that defines you, just a thing. And in that space, something interesting happens. You start to get better. Not because you're studying more or trying harder, because you're calmer. And calm traders make better decisions than anxious ones, every time. The fisherman doesn't leave the water wishing he'd caught more. He leaves satisfied that he fished well, that he read the water correctly, that he positioned himself right. Whether he caught 5 fish or 1 doesn't change that satisfaction, because he knows he did his part. The rest was up to the water. Trading is the same. Your job is to position correctly, to execute your process, to manage your risk. If the market gives you profit, great. If it doesn't, that's fine too. You did your job. You fished well. And tomorrow, you'll do it again. That's the game. That's always been the game. Everything else is just noise.